Welcome, everybody. Welcome this Tuesday afternoon here. I am live back down here on the floor of the SIBO in the S&P 500 options pit. And you know what? It's been quiet most of the day over the last 10, 15 minutes or so. It has actually picked up as we've seen the market kind of sell off a little bit. Not a huge sell off, but we've gone from pretty much up, 15, 20 points, good portion of the day. And we are now down nine and a quarter on the S&Ps right now. So things are picking up a little bit. We're also seeing the VIX start to pick up here. VIX traded down a low of 1667 today. And guys, when you see me looking up here, it's because I'm looking up at the big board up here. Traded down to 1667. It's now trading near its high of the day, just under, a shade under 18 right now. So, what is going on right now? I didn't see any news to come out that would have caused this. This, again, as we've talked about continuously, this could just be some positioning ahead of tomorrow's meeting. Anybody that says, yeah, they're on the inside of the Fed meeting right now because they are meeting as we speak right now, anyone that says, oh, they're hearing rumblings or they have an inside source that they know what the Fed is going to do, just look at them and run the other way, folks. They don't. I promise you. They don't. So don't even think about that because that is not the case. We will not know until tomorrow. We will know at 1 o'clock Chicago time, 2 o'clock Eastern time. We'll know what the decision is, whether it's 25, whether it is 50. And then we'll get, as we've discussed, we will get an immediate move. And then what will happen is, it'll do what it's going to do for 5-10 minutes or so. And then what will happen? Powell speaks at 1:30. That's when the real fireworks will start. And I'm going to get into this here, but tomorrow is one of the bigger expected moves for a Fed meeting that we have seen in quite some time, in about 10 years or so. So there is definitely volatility built in. There is a lot of angst. There is a lot of anxiety built in. And why is that? That's because you know what our go-to is here, guys. Let me get to our CME FedWatch tool here, which hasn't really changed at all from where we were yesterday. We're still right now at about 63% probability, and that's of a 50 basis point cut. 37% for a 25 basis point cut. What's kind of odd to me, and I'm going to bring Mike Shorr here in a moment. What's kind of odd to me is with all the thought process of if the Fed does cut 50, and I'm in this camp as well, that is kind of a little bit of a panic to the marketplace. Well, the probability, as you can see here, is for 50, yet the market is trading at all-time highs. So I'm not so sure that there is that much panic out there. I'm bringing in the man, the myth, the legend, at Mike Shorr, CBOT. Hey, guys, everybody say hello to Mike.
Hey, good
And
morning, everybody.
we are
Good
going to
afternoon.
we're going to get Mike's perspective today on what's happening with the market, and also because you guys know Mike trades a little bit differently than I do. Our signals and the way that we go about things in my option room, they're a little bit longer time frames. Some swing trades, we look a little bit more at volatility, where Mike, as you know, is day trading. And Mike is honestly, in my almost 35 years of doing this, Mike is absolutely one of the best day traders that I have personally ever met. So Mike, welcome in. What say you about the Fed before we get into any of your signals, analytics, anything like that?
Yeah, I'll admit that I've been thinking about this way too long, which means that I'm probably
I think we're
too
all in that
much.
same camp, right?
And it's been about a week. So, and I, I've, I've been, for since the rumblings of a 50, I've been thinking that they don't paint themselves into that corner, and I know the market apparently is asking for it. It's certainly
Yeah,
pricing it.
sure
And
is.
I think that, if they do 50, it signals either that they're, late again, right? I mean, they were late raising interest rates and now they're late bringing them down. And I just don't see the data behind any sort of a panic move like that.
No, not at
And why
all. And
would they?
excuse me for interrupting, and I agree with you. This morning we got retail sales numbers too, and you know what? They were a little bit soft, but nothing to write home about. No panic there
Oh,
that, oh my God, red flags are going up that the consumer's not spending anymore. So I agree
right.
with you. I don't see,
Inflation numbers, employment, and the active consumer. I the 25 cut, that makes total sense. But why they would paint themselves into this corner that,
yeah.
hey, we got it wrong again. I think that, ideally you'd say, wow, they cut interest rates by double than what we were thinking 2 weeks ago. So that's got to be good for the market, unless the only reason that the Fed is doing that is because they have big recessionary fears. And I just don't see it in the data. They might have data that we don't have, but I don't think so. And so,
Exactly. And you know what? Sorry for 1 second, Mike. We always do this live when there's something big trading here. And right behind me, I just panned the camera over to one of the brokers right behind me. And one of the brokers just came in to buy a lot of September 20th, so this Friday, 5,700 calls. So far, I've seen 1,200. Actually, there's another 650 of them right now that the market makers in the pit are selling them. So just a big order to buy some 5,700 strike calls right now that expire this week. All right, back to you, Mike. Sorry for the interruption.
no, so I still think that they go 25, and they maybe open up the language a little bit that gives them room to do it, at least one more time, maybe two more times this year. And I just can't see them. Like I said, it's like it's a self-inflicted wound and an unforced error for no reason.
Yeah,
Um,
I
and
totally agree with you.
and
Totally
so,
agree
so
with you.
then I turn to, okay, how do I make a bullish? How do I get a bullish bias out of tomorrow? Because if we get 25, then all the 50 people are going to be mad.
Yeah.
And if we get a 50, well, then they're like, well, something's going on that we don't know about. And until we figure out what that is, let's take some risk off.
And therein lies the rub why tomorrow's Fed move is priced in. So the at the money straddle in the S&Ps right now is priced percentage-wise higher than it's been in quite some time because the market is expecting a bigger move. And you know what? I'm going to pan over here for a second, guys. I'm going to go back to the CME FedWatch tool for a minute here. And I want to explain to everybody how this works, how you actually read this, besides just looking at this and saying, all right, 63% chance that we're going to lower 50 basis points, 37% chance that we're going to lower 25 basis points. How does this pricing work? So here's how this works. Okay. 100 is the basis. 100 is the basis of what the contracts are listed for the Fed funds rate. So if we look at this current target rate right here that I have circled, which that's the current before tomorrow's move, 5.25 to 5.5%. How do we get that? Well, 100 minus the contract price gets us to that 5.25, 5.5%. Now, you can see right now the current contract price is actually 94.83. If we take 100 minus 94.83, that gets us to, 517 or so. Woo, it's busy back here. That gets us to, 517. And that was just a mid price there. So I just want to show everybody how that pricing is figured out, the Fed funds rate, just from the current month contract. Okay, so the current month contract, it's 100 minus that contract gives us the targeted rate. All right, hopefully that wasn't too much information for everybody. Back to Mike here. Sorry about that, man. Just wanted to
Oh,
bring that in there.
well, that's great.
All right, now you think it's quarter. I think it's quarter. There's probably a lot smarter people out there than you and I are. That's why 63%
Yeah, that's why.
of a 50 basis point cut. But let me show you guys, and we talked about this yesterday a little bit here. Okay, historically, slower starts to the easing cycle are better for the market. This goes back to all Fed rate cutting cycles. Okay, we started on this yesterday and I found this graph. I did some research, found this graph here. Okay, if we get a slow rate cut, meaning 25 basis points for the first cut, you can see here what the gains are for the first year after that happens. If we get a faster rate cut, okay, meaning 50 basis points or more, you can see still gains in the S&P, but they are diminished quite a bit. So, if that's a precursor to what the market is showing us tomorrow, who knows? And then here's another one. What happens to to US stocks after the first rate cut? These are average returns here going back to 1989, so 25 years here. Okay? This is for all cuts. Here's our average returns. Well, I'm with all of you guys. I'm hoping we're in this camp here and not here. But we know what happened here. This was the great financial crisis. So is that a black swan? Is that a one-off? Maybe. Okay. This was '01. Now I'd have to go back in time and see what that was. It may have been the Russia crisis, but I think that's what it was. So let's hope one of these other ones play out. It is busy back here. Now, I was talking earlier about the implied move, what the market is pricing in for an implied move here. Here it is right now, 1.2% for tomorrow's announcement. Okay? Not since we saw back in late 22 and early 23, we haven't seen really the market price in this expensive of a move going into a Fed cut. Okay? All right, Mike.
Yes.
I want to bring up one of your charts here. And guys, please ask questions here about anything you want, whether it's to Mike, whether it's to me. Mike, I've got your chart up on the screen. Everybody should see this chart on the screen here. Okay, this is
Yep.
one of Mike's go-to indicators. This is called the ledge. I'm going to let Mike explain it and what to look for here. And I'll draw on the screen as he's explaining it. But this is one of his go-tos, especially in a really quick moving environment like we are in right now. All right, Mike, give it a roar
Yeah,
here.
exactly. So the principle behind this is based in statistics. And that's what a lot of it all comes down to: reward and risk and probabilities. But especially, and I use this just for day trading. It certainly can work in a longer time frame, but you're looking at a 3-minute chart here. And so when the market overreacts as a day trader, that's where we want to step in and say, okay, too much, because no market goes up forever, no market goes down forever.
Really?
That's true.
Come on.
Sometimes it feels like it,
Does
especially
feel
when
like
you're on
it.
the wrong side of it.
For sure.
But especially in the short term here. So what I look at is I have, and so we see this envelope that the top is right where you wrote 3-minute, and then that yellow line that is the same distance away, basically, that is your lower limit. And so what that is that is a 2 standard deviation move away from that purple line in the middle, which is our VWAP. So I run my VWAP on today only, so it starts at midnight. So it's going to catch part of the overnight session. There's not a lot of volume in there. And then you can see that as the day goes on, that envelope continues to build. And as we get further and further away from the VWAP, then our envelope around that VWAP expands as well.
Can't hear you, Danny.
So the 2 standard deviation from a statistical standpoint means that for a given distribution, statistically, that 95% of the prices should be below that upper line that we highlighted and should be above that lower yellow line. Just statistically, that, like we said, markets can do whatever they're going to do, but we base our approach to this in the realm of probabilities and not possibilities. And so when the market overreacts and gets outside of that, so you know that just being outside of that, statistically, you should have a 95% chance that it's going to get back inside of that envelope. Now, that just doesn't mean, well, we just sit there and we buy every time that it touches the upper line or that it touches the lower line, because the markets, and there's been angry sellers. It started right at 11:15 Central.
Yep.
And it wasn't any news or anything like that, but we've been talking all day that we could do nothing. We could be just range bound. We look up until 11:15. This was just a meandering market, and if you can pick where the highs are and you can pick where the lows are, there was some nice trade.
Yes.
And then out of nowhere and for no reason other than people will always ask me, Mike, why is the market going down? And I facetiously
more sellers than buyers.
They're sellers. That's why. Sellers are going to sell until what happens? Until the buyers stop them from doing that. Buyers are going to keep buying until what? Until the sellers come in. So what you're looking for, and especially when you see a big move like that, is, okay, I'm outside that 2SD envelope. I'm thinking that the market is going to correct itself. And so what do we use to figure this out? Now, I can't tell if you can see the VZO down there at the bottom, that little,
yep, all the way down at the bottom.
The other bottom study.
Yep.
It's kind of covered up by me. But so what that is, that's an indicator that I've put together. It's akin to the RSI. So if you know what the RSI is,
relative strength index, folks.
Yep. And I did, but I generally have a problem with the RSI because it doesn't take into consideration one of the two big things that's part of a move. One part of the move is the price, and one part of the move is the volume, and the RSI does not take the volume into consideration.
Which volume is a very, very huge leading indicator, guys.
Exactly. When nobody's participating and nobody really cares, well, then it's easy to push around a market. But when there's volume or something, that means that there's conviction one way or the other. And so what I look for is that when we get outside of this, and this would have been like so that was at 11:21.
Right,
that was
there.
Our first big foray to the downside, where we were well outside the 2SD envelope. And as you see, our VZO, because of the selling, was downward sloping. And it got to my measure of being oversold. These red, when it gets into the red, it's oversold. When it gets into the green, it's overbought.
And we can see that correlating with that bottom and that bottom green or blue line down there where it kind of stopped.
And so once we're outside the 2SD, and then we see an inflection in the slope of the VZO. So we see that it's downward sloping before that, and then you see that first V. And that's your indication to buy. We know that we're not statistically supposed to be down here. and now we're getting volume and price confirmation that at the very least the momentum of the downward move
has slowed down.
Exactly.
Yep.
And you can see we bought, well, at the time we bought it 3 cents off the low, and then we caught that move from what was that? It was 472.60ish, basically all the way back up to 473.60.
And that's a huge move. You're talking about 1 minute?
That was I'd have to check my trade log, but that was it. It was certainly within
90 seconds.
Yep. The same bar.
Yep, exactly.
And you see it happen again. Now this time, I was getting ready for this, but we see another one where here at you're not going to see it on this.
No, it's not on this slide right here. But
it happened again. Okay, trust me, it happened again.
And I bet you're going to show that tonight, aren't you?
I would like to.
Okay. So tonight, everybody, yes, we will get that on there. Tonight, everybody, Mike has a live webinar at 7 o'clock Central Time tonight. We're going to put a link up here in the chat where he's going to discuss the ledge. He's going to discuss exactly what he is explaining right now, what these moves were today. And again, why this is so critical and why it's his go-to, especially when we're getting market moves like this. Volume and price, guys. Volume and price. So, Irfan, I think that's your name. If it's not, if I mispronounce it, I apologize. He will give you lots of details tonight about that two standard deviation move. Okay, so anybody that wants to join in, there is a link. I want to hop over to something else here, guys, real quick. While Mike is here, Mike will talk about it as well. What I have up on the screen now, guys, this is called the skew index, SKEW. Okay, it's an index that the SIBO puts out. There's no options on it. What the skew index measures is how much the out of the money puts are trading versus the out of the money calls. Is there a skew? Okay, so we all know about the VIX, the SIBO product, the VIX, and what that measures, but that is measuring, the VIX is measuring at the money options. Okay, the skew index is measuring that tail risk. Tail risk meaning strikes that are far out of the money. Okay, out on the ends. Okay, so it's perceived tail risk in the S&P 500. Now, if you look at this here, you're going to see numbers on here, basically on this chart from 125 or so up to 165. When calls and puts, out of the money calls and puts are equivalent, okay, meaning the implied vol is equivalent, the premium is equivalent to those, and the probability is a normal distribution, that's the baseline for this index, and that is 100. That is the baseline. In fact, I'm going to bring up. I captured this about an hour ago. Let me get the live. Hang on. I know I have it here. Yeah. Now there we go. Now I'm getting it all the way back to. There we go. Now you can see it as low as all the way down here back in November of 2022, down towards 100. So again, what you can see is when the skew index reaches these levels here, almost like if we were looking at a stock and implied volatility is getting really expensive before an earnings and then it drops. Okay. These are the times in the market where people are paying up, paying extra premium for out of the money puts. Now, you would think that that might be a precursor to one of those black swan events or a big sell off. It's actually not. It's actually not.
I'm glad you said that.
Most of the time, I don't want to say nothing happens. We don't get that perceived sell off.
Yeah.
Okay. But this is so important to understand, everybody. If you follow this SKEW, this shows you what kind of those panic moves are all about, whether it's on the upside or the downside. Definitely something to watch. And again, if you take away nothing else but this, the difference between the skew index and the VIX is the skew index is looking at those outlier moves, looking at those out of the money puts, out of the money calls, where the VIX is we're getting our measurement from the at the money straddle. Okay, the at the money straddle. Now, while we've spoken here, the S&Ps are back to pretty much unchanged here on the day. Let me bring Mike back in here. There we are. Excuse me. There we are. So, Mike, I've been talking to everybody here about what to kind of expect tomorrow, not in terms of 25 or 50, but how does the trade work? When Powell or when they come out with the announcement at 1 o'clock, we're going to get a little bit of a move, and then it'll probably fade off after 5-10 minutes
Right.
until the big guy gets on the screen and starts talking to everybody. So how do you as a day trader, because again, the positions I'm putting on are different because they're a little bit longer term in swing trading. How are you as a day trader prepared to trade the Fed announcement?
Yeah. Well,
And don't say very carefully, which it
well,
probably is.
and you have to be. Usually the way that we like to play it is one, there's usually the first reaction is the way that you want to go with it. And one thing that I want to emphasize here is, that I pull my allocation all the way back to trading one lots when this stuff happens, because you can see this stuff gap, in the Qs or SPY 50 or one full point in seconds. And so you have to be very nimble. And it's very easy to get run over. And so you have to pull back on your allocation, and you have to widen out your risk a little bit, because you could be right. And then if you get a small jiggle in the price, then you end up being wrong.
Yeah, and we know also with a stop there also, you want to have those stops in because of the risk, but you probably have to widen those out a little bit.
Yep, exactly. So lower allocation, wider risk. And then once you get an idea of what the general trend is, we're going to calm down. That's and depending on how much the straddle has come off, so the straddle buy at the money call, buy at the money put, or slightly out of the money strangle, buy slightly out of the money put, buy slightly out of the money call. If they hit that implied volatility between 1 and 130, sometimes that happens. Oftentimes it stays up there because people really care more about Powell than they do about the announcement. In this case, I think the announcement is going to be, it's going to have more weight. I don't want to say it's going to have more weight than what Powell actually says, but it's going to have more weight. So we could see vol come in a little bit once we figure out if we're getting 25 or 50 and what they say about going forward.
Right.
Then,
well, and what I was going to say, the going forward part, at least tomorrow, we get their dot plot tomorrow, which only happens 4 times a year. So that's a little bit more significant than normal.
exactly. So if they do hit that implied vol enough where we're not looking at a $4 or $5 straddle in SPY or Q or something like that, then what we like to do is we put on and for something like tomorrow where we're expecting a bigger move, I'd most likely look at a strangle. And what I do is we buy a strangle, and then so we buy a strangle at first by itself, buy that as a spread, and then we take the pieces and we run a fairly wide stop on either side, because most likely we're either going to get a big reversal from what he said, from what the announcement came out and said versus what Powell says going forward, or we're going to, let's just say that we go up a little bit after the announcement, implied vol comes in, but if we see Powell start talking and then to the call side, we want to have a stop there, because usually, I'm trying to remember a Fed where we had a wild down move and then a wild up move. It tends to be a snowball or a truck that you don't want to get in and most likely you would much rather be on the winning side of that. So the concept is, again, we don't know where it's going, but we know it's going somewhere. So we hope that, let's just say that we buy, a strangle for $2 or something like that. And let's just say call and the put where they're exactly the same. I'll run where normally my risk is usually somewhere between 7 and 10%. I'll run like a 25% stop on either side, just so you don't get chopped up in the middle if we start going back and forth. But eventually we're most likely going to get a protracted move one way or the other.
And so remember, everybody, I'm sorry, when Mike said also buy that strangle, that was after we've already seen an initial move where volatility has started to come in, not buying a strangle pre-move, right, Mike?
Right. And if they don't hit the vol, well, then we'll approach
sit
it
on our hands. Yeah, exactly.
And so the idea is that let's just say that we lose 25 cents on the put and the call takes off and we make hopefully 75 cents or $1 on that, because trying to guess direction is difficult. And so if you can responsibly take both sides of the fence and respect your risk, I can't emphasize that enough, especially on days like today and days like
there's that old saying that the market can stay more irrational than any of us can stay solvent or liquid.
That's right.
Got to remember that.
That's a great
Got
quote.
to remember that. All right, guys, it is that time. It is that time. Mike, thank you so much. Again, I know Mike just touched a little bit on this ledge concept of his, this ledge indicator, which is unbelievable for this type of trading. If you're interested, make sure you just click on that link or register for that webinar, and Mike will give you all you want to know tonight about that ledge, 7 o'clock Central Time. Tomorrow, everybody, tomorrow we'll be here, but we're going to come a little later. We're going to be here, so we are broadcasting live during the Fed announcement. So tomorrow's live stream, and we'll let everybody know, will start at 12:45 Central Time instead of 12 noon. Thank you, everybody. As we leave here, S&Ps are back in the green. Have a great day, everybody. Thanks again, Mike.
Hey, thanks a lot for having me.